In the last year, startups raised over $119 billion in funding. SaaS companies, specifically SaaS startups, raised over $40 billion in funding in the last year alone. Investors are investing more money than ever before thanks to this AI platform shift. However, and this is an important but, investors are doing fewer deals. So here's the big question. How do you actually rise above the competition? How do you actually get the attention of investors? And how do you successfully raise so you can scale your company? In this episode, I'm going to walk you through the 10 things you should never say to investors, particularly in this market. I'm going to walk you through each of these 10 things, and then I'm going to explain exactly why these 10 things are the ones to avoid. And then in the end, I'm going to walk you through how to win in this market. When you apply the principles in this episode, you will be able to raise that next round of funding, and you'll be able to accelerate your path to that next stage of growth. Intro. What's up, everybody? Welcome to Unstoppable. I'm TK, and on this channel, I help AI and SaaS founders like you grow your businesses faster with an unstoppable strategy. Now, if you're new to this channel, welcome. I drop an episode every single Sunday with actionable strategies and tactics from the trenches on how to grow your AI and SaaS business faster. So be sure to hit the subscribe button and that bell icon that you'll get notified every single time I drop an episode. If you're already part of this community, if you're part of my SaaS go-to-market coaching programs, my people, welcome back. Really awesome to see you over here. All right, so as I said, here's how I'm going to break down this video. I'm going to walk you through each of the 10 things not to say to investors in this market. And then I'm going to explain exactly why these are the 10 things, why I have high conviction around it. And then in the end, I'm going to explain exactly how to win and rise above the competition, because there is a lot of competition vying for those dollars and investors are doing fewer deals. And by the way, the reason I'm sharing all of this is because I've literally been in your shoes. My last company, ToutApp, it was a SaaS company. We pioneered the sales engagement space. As a solo founder, my angel and seed round included the likes of Esther Dyson, Founder Collective, and Jason Calcanis. I then went on to raise my Series A backed by Jackson Square Ventures and my Series B by Andreessen Horowitz. I then scaled the company, sold it to a market leader called Marketo. Marketo at the time was owned by Vista. Vista is pretty much the best private equity firm that exists in SaaS and AI today. As part of the acquisition, I joined Marketo's executive team as SVP of strategy. And one of the things I was responsible for was acquiring more startups. So I served as a form of an investor to actually do acquisitions on behalf of Marketo. We did a 2-year transformation at Marketo. We sold Marketo to Adobe for $4.75 billion. And then I started my current company, Unstoppable, which is a coaching business for SaaS and AI founders. Over here, I have helped hundreds of founders add millions of revenue with a scalable go-to-market strategy. Each of these principles I'm sharing over here, I've learned and lived in my own journey as a founder, and I've helped other founders actually apply to scale their companies. So if you're excited to dig in, go ahead and smash that like button for the YouTube algorithm. And let's go to principle number 1 on what not to say to investors when you're in front of them. So the first thing that you should not say to investors when you're pitching them is that we are pre-product. And this is one of the things that I've seen a lot of founders get really stuck on, especially the early stage founders. And by the way, each of these, because I've gone through the whole journey of pre-seed, seed, Series A, Series B, exits, I'm going to make sure I cover the 10 things to cover as you go through further rounds as well. So the later ones are going to be for later rounds, but they're all going to be relevant for you. So the first thing you want to make sure you don't say is we are pre-product. And there was a certain period of time where there were pre-seed investors and they would talk to you if you were pre-product. But today, with AI, with vibe coding, with Claude Code, with Lovable, you name it, it is pretty much table stakes to say, hey, we have some version of a product. And if you don't, it is a huge red flag. And at the end of the day, none of these things are terrible, but if all the other founders that the investor is meeting has a product and you're the only person that has no proof points and couldn't even hack together a V1 MVP of a product by putting in a bunch of prompts into Lovable and getting some people to try it out, then you just don't stand out. So the first thing to not say and never say in fundraising today, especially with everything that's going on in SaaS and in AI, is to say we are a pre-product, because that's just not allowed anymore. The second thing that you absolutely are not allowed to say and should never say is we are pre-revenue. And again, this is kind of going on the same vein. It is easier than ever to get some people to try your product and pay for it. Honestly, it just is. Between cold emailing platforms, LinkedIn, social media, YouTube, Reddit communities, you name it. There are just so many different channels. There are so many different ways to get in front of your ideal customers and even charge them $9 a month for a product. If you're still in that stage where you're like, hey, we have some design partners, but they don't want to pay, and we're gonna have them try out the product, it just doesn't come off as competitive as the founder that is able to say, hey, we have 3 design partners. They paid us a pilot fee. We've seen success already, and now we are raising. Or even better yet, we actually went out there and we posted on X and we posted on LinkedIn, and we got a bunch of our ideal customers, and we have some initial revenues, and now we're looking to scale. The majority of founders out there are actually getting some level of traction to actually de-risk the investment. And ultimately, that's what all of this is really about. A lot of these things that investors are really looking for, they're trying to de-risk the investment. Early stage investing is super risky. There's still a set of things they can do to de-risk that and set up the likelihood of success, which is why they're at this point in this market looking at, do you have some version of a product? Do you have some revenue? Were you able to convince anyone to pay for it, even in a small way, because it de-risks the investment, and also just shows that you're capable of breaking through the noise because it's so competitive right now. The third thing to never say to an investor is we have no marketing or sales. I've seen some founders say this almost in like a boastful way. Like, oh, we have no marketing. And in a way, you could say that and you think it makes you look smart. But in my opinion, what I found is it actually makes the founder look dumber. And the investor is thinking, well, I don't think this guy really understands his business, or I don't think this person really understands their business. And the reason for this is, let's just say you have some revenues and you have some customers, and you go into a pitch meeting and you say, we have done no sales or no marketing. We just, our product's that good. That's just not true. In fact, it's the opposite of true. You did some level of marketing. You went somewhere and talked to some person and got them to sign up. Maybe it was through your existing network. Maybe it was through referrals. Maybe it was through LinkedIn. Maybe it was through cold emails. No marketing and no sales is no longer a badge of honor. It used to be that it was a signal like, oh my God, the product is so good, it's spreading like wildfire. But even that is a form of marketing. It's viral marketing or referral marketing or word of mouth. But the fact that you cannot recognize that and communicate that to the investor is a red flag, which is why saying we have no marketing or sales just makes you look kind of dumb to the investor. And the investor's like, this person just doesn't even understand how their business is growing because the default state is 0 and obscurity, and they have found a way to break through, but they can't articulate why they broke through. And that's crazy. So you never should say to an investor that we just have no marketing and no sales. Now, those are the first 3. Before I go through the rest of them, let me pause here for a second. Some of you are probably like, oh my God, I have been doing some of these things, and no wonder investors keep telling me, oh, just come back to us when you have your first customer. And then maybe I got my first customer and you went back and like, well, just come, and they made up some other excuse. So if you're starting to see that investors kind of lie, and they kind of have to, because they never want to say no to you. They never want to say, oh, you are terrible, never talk to me ever again, because you might actually watch a video like this and wisen up and completely change the trajectory of your company tomorrow, and then they won't get the investment. So they'll always kind of say, oh yeah, just do this one thing and then come back to us. This is why you just should never say these things, because it forces them to lie. And instead, you should just know what they're expecting, even though they're not saying it outright. If you're starting to see the power in this, before I go to number 4, can I just get a yes in the comments below? And also smash that like button for the YouTube algorithm. It just loves it when you do that. Also, one of the key things you'll see over here is you're trying to figure out, well, what should my first product look like? How do I get some revenue, get in front of some of my customers? How do I figure out what my customers are and what do I say to them? A lot of this is go to market. That's not so much about building the product, but it's really understanding the market you're going after and how to go to that market. So for founders who are figuring all these pieces out, I created my 5-point AI and SaaS growth strategy guide. You don't have to go anywhere right now. I'll link to it below. I'll tell you more about it at the end of this episode. But right now, let's go to number 4. So the fourth thing not to say to investors ever is we have no competition. That's the fourth one. This is along the same vein where when you say this, It signals that you haven't thought deeply about the business opportunity. It signals that you haven't really thought deeply about what the chessboard is and where you're even playing and how you're going to win. Because the reality is, even if there's two things here. One, even if there isn't another startup and another company doing this, there is the default state of apathy. Humans are pretty lazy. So your competition may just be the status quo, or it could be an Excel spreadsheet. And at the same time, that is still competition because you're trying to change their behavior. So that's one. You do have competition. You have to recognize it. The second is, because there's no competition, and you say there's no competition, it could easily be that there's no alive competition, which means there's an entire graveyard of companies that have tried this and massively failed. And you not knowing that and talking about that works against you as well. So there's always competition, but you have to be able to articulate like, look, right now, there aren't any companies approaching this problem and solving it in this way. Now, here's how we think we're going to overcome this. Because one, here's how we're going to convince them to use our software, even though they're stuck on the Excel spreadsheet. And two, here's what we learned from the 5 companies that have failed in this market. You notice how that's so different than just saying we have no competition right now? And that signals to the investor that, oh, they've thought about this. They kind of understand what they're up against and they have a plan to get around it. All right, so that's number 4. Don't ever say we have no competition. Number 5, and this is more true today than ever before, is to tell investors, and I'm going to caveat this and explain what this is. We vibe coded our product. I have nothing against vibe coding. I think vibe coding is incredible, and everyone should be vibe coding. Engineers should be using Claude Code. Non-technical founders should start with Lovable. I believe in all of these things. At the same time, if you are talking to an investor, you're inherently telling them, let's just change the words a little bit. Instead of saying, I'm starting a software company, will you invest in it? Just to say, instead of software company, you're starting a rocket company. You can say, hey, I'm starting a rocket company. The first thing the investor is going to wonder is, awesome, I'm super pumped for you. Who is the rocket engineer on the team? And if you don't have a rocket engineer on the team, the investor is just not going to invest in you. And they're certainly not going to write you a check so you can go hire some rocket engineer. It's just not going to be the case. And to prove that to you, let's just take the obvious example. Let's take Elon Musk. Elon Musk early on pretty much figured out that he had to learn rocket science himself to be able to raise money and make SpaceX work. And that's Elon Musk. Even for Elon Musk, he was like, hey, I got to learn this myself and I got to figure it out. And then I can recruit some great rocket scientists. For you, I'm not saying you have to learn how to code. Maybe you do, maybe you don't. But if you're going to raise money, you're going to have to be able to show to investors that you can recruit software engineers as a co-founder. There's some edge cases here. I've seen people say, oh, we have this outsourced firm and they're building it out for us. That may be true, but then that'll also be a red flag to the investor because that's very expensive. And yes, I know they quoted you like $50,000 to build out the version 1, but the truth is version 1 is never gonna be the one that your customers actually use. You're gonna have to keep iterating on it, which means that it's even more spent and it's gonna be very expensive. And investors don't like that. It's also a negative signal to the investor when you're literally telling them, hey, I have no idea how to recruit a technical founder or a software engineer for my software company or a rocket scientist for my rocket company. That's literally what you're saying when you're saying, I don't have a co-founder that can code. So while vibe coding is very, very good and amazing, and you can get amazing results, if you're truly gonna raise money for a software venture, you need to get out there and figure out how to get another person that's a software engineer to join you. And I'm not saying you got this, fresh out of college kid who has a computer science degree and you gave him 3% equity, because investors will see right through that. That does not count. And in fact, that will be a negative mark because they'll be like, oh, this guy's kind of sketchy. And they're giving this person a sketchy deal. And then they'll definitely not invest in you. Never say we vibe coded our product. Even if you did, you can say like, hey, we use Claude Code and a lot of this is vibe coded or a lot of this was used by AI. But behind that AI is this really smart co-founder of mine who understands the architecture behind truly delivering an enterprise grade product, which is super important. All right, so that's number 5. Number 6 is one of my favorites. We're kind of working up the stack from like team to what the product that you're building to like what the competitive dynamics are to how you actually build a product. And now this one, these 6 through 10 go into theme number 2, which we'll cover in under the why. The 6th thing to never say to investors is we have a huge TAM. And we've all seen the slide. We've seen it in the past years. It's like, hey, this is $100 trillion market, and even if we get 1% of it, it's gonna be huge. We have a huge TAM. Don't do it. Don't say it, especially today. Because there's a few things here. One, markets are way more defined today than ever before, especially in the software market. And right now, between AI and SaaS, you're either going after the traditional SaaS market or you're going after the labor market with AI SaaS companies. So these are all quantifiable. On top of that, you are one Google Gemini deep research query away to get into specifics around this is the specific market, this is the current spend, this is our ideal customer profile that we're going after because we think we can compete, because our competitive differentiation is in this way, and here's how we're gonna get at them. You can get to that level of specificity. And if you can't communicate that to the investor, you're gonna be the founder that can't do it while all the other founders are doing that. And therefore, you're not going to get the investment. So you should never just say, we have a huge TAM, even if we get 1% of it, it's gonna be huge. It's just not good enough anymore. You have to actually communicate your market thesis. Here's the market, here's what it is existing, here's how it's expected to grow, here's the part of that market that's gonna be our ideal customer profile, here's how we're going to differentiate compared to the competition, and here's how we're gonna break through. You have to have that level of thesis. And if you don't, that's okay for you, but the investor is gonna move on. So you should never say that. And by the way, you'll start to see how these all build, and I'll explain why, what the core themes are, and why I have high conviction around these. By the way, if you're already seeing the power in this, go ahead and smash that like button for the YouTube algorithm. It does love it when you do that, and so do I, because it just means the world to us. Number 7 is we need intros. This is one of the things that, I used to be a nice guy, then I started a company and I learned a bunch of things. I think it's one of those things where we think that it's the investor's job to make our dreams come true. And it's the investor's job to give me that dollar so that I can really make my dream come true and really bring this amazing thing to the market. And it's not your fault to believe that, because in a lot of ways, investors, that's their marketing. But that's not their job. It's not their job to make your dream come true. It's not their job to fund you. It's not their job to improve society. They only have one job. Their job is to take the capital they took from their LPs, their limited partners, the endowment funds, the state funds, the institutions, you name it, to take that money and 10x it. That's their only job. And give a return that's better than just putting it in the S&P 500. That's their job. That's it. It's also not their job to find you customers. It's not their job to recruit for you. It's not their job to care about you. Now, it would be nice if you get an investor that cares about you and recruits for you and gets you some customers. But those are nice to haves. So investors know that, and the best founders know that. And so your job as a founder is to show up and say, hey, I know how to get my customers. I know my market. I know my competition. I know how to differentiate. I already won some deals. You are gonna give me money, and I'm gonna give you back 10x that. That's your job. And their job is to look at you and decide if you're telling the truth and if you're likely to do it or not, and place their bets. That's their job. When you show up and you are like, hey, we could use some intros also with that check. They're like, dude, that's your job. Why do you need me for that? I'll do it if I can, but that shouldn't be what you're looking at me for. Similar to that, it's not their job to care. It's not their job to fund your dream. It's not their job. Which is why you never want to say we need intros. You never want to say, hey, we need these 5 things from you. Their job is to give you the cash. And your job is to return 10x that. That's it. That's the transaction. Everything else that's layered on top, upside. It's great. If you got 2 term sheets and one of them provides more of that value, maybe you pick that one. Maybe you like him more. Maybe he likes you more. Maybe she likes you more. Either is fine, but it's not their job to get you intros, and you just want to show up there. And the reason I put number 7 here is not just asking for intros, but it's for you to know the role and the vibe and how you want to show up. You're not showing up for them to tell you that you have a great idea. You're there to tell that person, that investor, like, this is a great idea. Here's my thesis. Here's the competition. Here are the customers. Here's the traction. You're going to give me money, and I'm going to give you 10x back that. That's your job. That's what you do. So that's number 7. Number 8, 8th thing to not say. This is the kiss of death to investors. We'll be profitable. Kiss of death. And this took me a little bit to understand when Baby TK was first fundraising. Like, I didn't really know anyone in the Valley, and I came in. I knew some people, but for those people, I didn't want to ask them for help for a whole bunch of reasons. And maybe I'll cover that in another video another day. I love those people, but I didn't want to ask them for help. I wanted to prove that I could do it on my own. So effectively, I had no network. And I showed up in the Valley in San Francisco, and I built my way up all the way to Andreessen Horowitz, all the way to Vista. I raised from the best venture capital firm and sold to the best private equity firm, worked with both from nothing. And so I learned a lot through this whole process because I just saw how the best of the best operate. I also saw how some of the worst people operate. But one of the things I learned is this whole ecosystem, this whole business model of venture capital and startups, it's not about profitability. There are certain years where that'll be the thing, like, oh, we got to get to disciplined execution, unit economics. But here's the shift you want to understand. The venture business and investors are about enterprise value, not cash flow. They're about enterprise value. Enterprise value is the higher your growth rate, the faster you're growing, the more your valuation. The more your valuation, the more they can value that investment. So let's just say they put in $100,000 and you are at $100,000 of revenue. And then you start growing 1,000% year over year. Well, now they can take that $100,000 investment and mark it up to a much higher enterprise value because you're growing so fast. On the other hand, let's just say you're $100,000 and then the following year, you're now at $200,000, but you made $100,000 in profit and you call them up and they're like, hey, where should I send the check? And they're like, what are you talking about? And you're like, well, we have a profit distribution. They're gonna be like, what are you talking about? I don't get paid for that. What I get paid for is to tell my LPs that I'm gonna 10x their money, not give them back some chump change. And I don't mean that in a terrible way. I run a very profitable business with Unstoppable. I have run venture-backed companies and I have investments and I have companies where I am looking to increase enterprise value. It depends. There's nothing wrong with bootstrapping. There's nothing wrong with profitability. But you just want to understand what game you're playing. In the venture game, telling an investor that we're going to get to profitability is the kiss of death. They don't want profitability. They want to increase enterprise value. And the fastest way to increase enterprise value is growth. If you have EBITDA, if you have profits, you get a 4x multiple on your business, on your revenues. If you have recurring revenue and it's growing at incredible numbers, you get 10x to 50x valuations. That's what they want. So never say we'll be profitable. They don't want you to do that. You're talking to the wrong people. Go to the dentist. Maybe they want to invest. They have plenty of cash and maybe they want profit distributions, but not to the venture capitalist. And there are lots of rich dentists, apparently. They have a lot of cash flow. I have some doctor friends, lots of cash flow. They would love profits, but not venture capitalists. Just know the audience. Number 9, I was debating whether to put this because I'm like, will this be widely applicable? But I think it is. I think it is. So put in the comments if it is. We are raising 100K. To 99.9% of the universe, 100K is a lot of money. To most people, to almost everyone, it's a lot of money. However, in company building, in early stage, 100K is not gonna get you what the investor needs. Let me first explain what the investor needs, and then let me explain why the 100K is not gonna get them there. Here's what the investor needs. If they're coming in on a seed round or even a Series A, they need one thing. They need to make sure that you raise the next round so that you can keep driving growth and keep increasing the enterprise value and eventually exit. Not exit right now. They don't want you to have an exit strategy right now. They want you to grow as fast as possible and take it to the moon, but eventually exit. That's what they need. So the biggest thing they're really figuring out is, are they in a market? Is there a real market? Can they compete against the competition? Do they have the right people on the team? Is there an actual rocket scientist with a rocket company? Is this a big enough market so we can drive that kind of growth? Are these founders going to be able to figure out their go-to-market, or are they going to come to me asking for answers to the homework? Are they going to shoot for the moon? And are they going to raise enough money to actually fund that growth? Because let's be honest, in order to get that growth going, they need to fund some things. A VP of marketing costs $300,000. A great software engineer, $200,000 to $300,000. It costs some money to drive growth. Ads, a go-to-market machine, it costs money. So if you come in and say, hey, we're gonna raise $100,000, it pretty much sounds in their head like we're gonna raise $100. And they're like, what are you gonna do with that? It's a lot of money, but not a lot of money to be in it, to win it, to really take this to the moon, for it to matter for me. And this is one of the things that I think a lot of people don't fully understand. I didn't. So let's just say this VC you're talking to has a $100 million fund. With that $100 million fund, they'll do what? 20 investments? depending on their check sizes. 99% of them are gonna fail, one is gonna win, but that one is gonna have to return that fund and then 10x that. That's what we call venture math. So if you're just raising $100, you're probably gonna be the one that fails. I can't do that. In order for me to have where I stand a chance of one of my 20 investments to win and return my $100 million fund and then profits on top of that, in order for that to happen, each bet I make needs to have the thesis that it can become huge, which means that each bet that I make has to be able to raise the next round, has to have the founders that can raise the next round, has to have the thesis where I can look at it and say, yeah, this can get huge. Each of these can get huge, even though I know 99% of them are gonna fail and one is gonna win. That's the bar. So a lot of times founders go in without really understanding what they need to win. And they ask like, oh, we just need $100,000, which signals to them like, these guys have no idea what it takes to win. No idea, which is why you should never say that. You should really do your math to understand what is our go-to-market strategy, what is our market, how are we gonna win, how much will it cost, and how are we gonna deploy the cash so we can go back to them and give them 10x return. That's what it takes. Number 10 is basically going to them and saying, we are delusional. I save this for last because I know that you're not gonna go and say we are delusional. Like no one says that. But there are certain things that founders do and say where that's what investors hear. Like you'll say the thing and they're like, oh, we are delusional. That's what they hear. So you don't wanna say that. And how do you say that? Let me give you two separate pitches. It's like, hey, we're starting a company. It's called Flow. This is the market we're going after. Here's how much businesses are spending for this very specific problem that we solve. And they're spending this right now, and these are the problems that exist. And we found that if we create a SaaS platform with an AI agent on top of it, we can solve this problem at like 10 times better. And here's how. And what we found is when we went to existing customers of these companies that exist, the competition that exists, with our initial product, it delivered way better returns for them and they switched over to us. And we didn't tell them to switch right away. We kind of plugged into the existing system and then we migrated them over once we showed success. And so we think that we can take on this entire market and we can really capture not just the software spend, but also the labor spend. And this is what we've got so far. And what we want to do is get to this stage and here's how much we need. So that's why we're raising this round. Let's just call that pitch A. Pitch B. Pitch B is like, hey, we have this amazing product. It's revolutionary. It's an AI agent and it's going to be huge. It goes after this market. And if we could just get even 1% of that market, it's going to be amazing. We haven't gotten anyone to pay yet. We have a couple of people on the waiting list. We have a design partner that says they're going to do it. I'm still looking for a technical founder, but don't worry, I vibe coded it. We're looking to raise some money so we can really make this all come true. It's going to be huge. Which one do you think works better? Now, obviously, I'm kind of playing to the extremes here, but you can see how that second one makes you sound delusional. And the fundamental reason is you're not getting into specifics. You're not doing deep thinking. And the bar has gone up because it used to be there were a whole bunch of unknowns. You'd have to do like a $100,000 research study to really figure out the dynamics of a market. And now you can do a Google Gemini report. The stakes are higher, the bar is higher. So this level of specificity needs to be higher. You need to show that you really thought through this and you've gotten some traction. And by the way, I'm not saying everything's perfect. If you think about pitch A, I'm like, well, we got some competition. We think we're gonna do it better. Here's the proof points we have. Here's what we're gonna do next. We've already de-risked a bunch of stuff, but there's more to do. I'm being very upfront. I'm being very direct. I'm being very transparent. And we've checked off some of these. We didn't say we're pre-product. We didn't say we're pre-revenue. We have some revenue. We didn't say we have no sales and marketing. We explained the competition and how we're dealing with them. I explained that we have a team. We didn't just vibe code it. We got specific about what we're gonna go after and how it's gonna expand over time because we're thinking about software budget and labor budget. And we're just saying, hey, give us the money and we'll give you more money back. That comes with a level of conviction, certainty. Those are the founders that get funded. Everyone thinks like, you watch enough TV and movies, you think it's the founders making crazy claims. No, they're the ones that end up in the Forbes 40 under 40 list and then end up in jail a few years later. Huge difference, huge difference. No offense to the Forbes 40 under 40 list founders if you're watching. Now let me explain why. Why these are the 10. I've already kind of double clicked on each of these, so hopefully, you kind of understand already, but there's two big things. Remember how I was telling you how investors are in the business of not funding your dreams or making society better, well, those are upsides, or helping you find customers. They're in the business of returning capital to LPs, and they're capital managers. And when you're a capital manager, you're also a risk manager. So there's two key buckets. Let's just call this bucket A, and let's just call this bucket B, that they're managing risk around. And that's what these things are about. A is the product market fit bucket. They're trying to manage the risk around product market fit. The more of a product market fit you are, the more likely they are to invest, no matter what they tell you. No matter what they tell you, even if they're like, oh, we invest in people, you don't even need anything. True, we need some pedigree. So they're not entirely being honest, but they're not gonna say no to you because tomorrow you might have pedigree. They don't want to screw you up. So the first is, hey, what's your product and market risk? And have you started to manage for that? If you built a product, you reduce the risk. If you've gotten some revenue, you reduce the risk. If you start to think about how to get to these customers, you reduce the risk because it means that you know who your customer is. If there's competition, you reduce the risk because there's others playing. They've reduced the risk with you. And if you have a technical founder, you reduce the risk. You can have a better product market fit. That's the first class. The second class of risk is go-to-market risk. They're trying to figure out, is there enough of a market here for this to really get 10x my fund? Do these founders understand sales and marketing? Do they understand what it takes to win and return venture scale returns or even take a shot at it? And are they grounded enough to understand what they need to do and who they need and where they need help? Do they understand that they probably can't hire the VP of marketing until they get to a Series A, so they're gonna get dangerous enough in founder-led marketing? Or are they just thinking they can hire an agency? Like, these are all the things that the investor is starting to understand and assess around and assess the risk around. So these 10 things that I never want you to say to investors are really around reducing the risk perception that investors have when you're talking to them. First one is the product and market risk, and the second one is the go-to-market risk. So that's why I have high conviction around these items. One of the biggest things I'm obsessed about is Charlie Munger's inversion rule. It's like, it's not about how do I raise fundraising, it's what do I need to do to completely lose at fundraising. These are all the things. You just flip them, you're gonna be super successful. So that's how I came up with the list, and that's why I have high conviction around this. Now comes the how to win. Remember what I said in the beginning of this episode, and those numbers are amazing, right? Like over 119 billion of capital deployed into startups, 40 billion in SaaS companies, and they say SaaS is dead. It's not. Now it's AI SaaS. That's just what I call it. There's more capital that needs to be deployed, and everyone's aligned around, hey, this is a platform shift and we're gonna invest in it. So all of this is true. But also remember what I said, they're doing less deals. They're doing less deals, but writing bigger check sizes, which means they're taking even bigger swings, but on a concentrated number of bets, which is what I think is the right thing to do. So how do you win? How you win in this market? The biggest thing is distribution. Distribution is the biggest thing. Having a proper go-to-market strategy, a scalable go-to-market strategy as you start to learn more in the market is the thing to win. Because I guarantee you come in front of an investor and you have a well-defined go-to-market strategy and you start to show proof points and you really show that you understand your ideal customer profile, the problem that you solve, the competitive dynamics, and you start to break through and get the attention of the market, you're getting pipeline, you're starting to win some customers, that's how you raise the next round. And that's true in every stage, whether you're pre-seed, seed, Series A, Series B, Series C, onwards. Distribution, that's the way to win. Now here's a big question. How do you actually get distribution? How do you really de-risk these things and really figure out what's the product, what's the target market, what's my go-to-market, what does my pitch deck look like? How do I communicate this to investors? How do I get the traction going? This is why, for founders that are at this stage and figuring these pieces out, this is why I created my 5-point AI and SaaS growth strategy guide. Inside of this guide, I walk you through the 5 key components of driving success and growth for AI and SaaS companies today. It goes from market to product to go-to-market to fundraising. It has key resources for all of them. It's completely free. So to grab your copy, just go to getunstoppable.com/strategy. getunstoppable.com/strategy. Or you can just go to the link in the description below and click on it and get access to it on demand. And inside of that guide, I'll walk you through each of the 5 components to really fleshing out your strategy. I'll link to specific resources that I have, and I'll even give you a template to codify your strategy into a 1-page plan. It's an incredible guide. we've updated it for this AI era. So to grab your copy, just go to getunstoppable.com/strategy. Now, if you got value from this video, please smash that like button for the YouTube algorithm. It just loves it when you do that. I also drop an episode every single Sunday with actionable strategies and tactics on how to grow your AI and SaaS business faster. So be sure, if you haven't already, to hit the subscribe button and that bell icon, where you'll get notified every single time I drop an episode. If you have a fellow founder, if you have a team member, if you're part of a Slack group or WhatsApp group of other founders that get value from this video, please share this with them. I want to serve as many founders as possible in this incredible time of building software companies. Also, if you're in that stage where you're starting to think about what does it mean to be a SaaS founder in today's day and age, what's going on with AI and SaaS and what are the big macro trends, then you should check out this video. Inside of this video, I give you my 3 key macro trends that are happening in SaaS and AI today, exactly what they are, why I have high conviction around them, and how to win in this market on building incredible AI SaaS companies, which is what's winning in the market right now. You can check that out over there. And lastly, remember, everyone needs a strategy for their life and their business. When you are with us, yours is going to be unstoppable. I'm TK, and I'll see you inside all of these things. I'll see you inside of the guide. I'll see you in the next episode that I just linked to. And also, I'll see you inside one of my coaching programs when you're ready to scale your go-to-market. Take care, everybody.